Assalamualaikum everyone. Good evening. How's everyone? Are you listening, guys? Any question? Today we should have lots of questions. So ask. Ask those lots of questions. Okay. Okay, during the session. Okay, perfect. Give me 1 minute, guys. Okay, let's start discussing the risk management area. Okay. In exam, you should know how to convert the currency. What is purchasing power parity? You should know that. What is interest rate parity? Maybe in some of the question, examiner can straightforward ask you about the purchasing power or the interest rate parity. Otherwise, it is the topic of the previous area. Now, translation risk, economic risk, and transaction risk are very important. And one of the past paper, examiner has asked all the data about the translation, transaction, and economic risk. I still remember even the December attempt question was almost like the copy of that question. Question name is Lignum Company. It's a previous attempt question. It's an old question, but December 2022 question is has much similarity to that question. So translation risk is you have a subsidiary in other country and the currency of that country is depreciating. So whenever you are translating the balance sheet of that particular subsidiary into your parent company currency, you will face some kind of hit, because whenever you translate the foreign currency into the home currency, in the parent currency, you will receive the less amount. So assets will translate into lower amount. So that is the translation risk. So you should know what is translation risk. You should know how to hedge it. And the main thing is you should know that how to manage that risk. So in that Lignum company, there was a case that this is a subsidiary company and this is a parent company. And for example, this is asset. These are liabilities. So what you have to do? You have to convert the subsidiary company data into parent company data as closing spot. And similarly, you have to convert the liabilities into parent company liabilities at the closing spot. And your risk will be on the net assets, This is total assets. These are total liabilities. These are net assets. So in that particular question, previously in last year, you were converting at 35 ringgit per dollar. Now the ringgit has been depreciated at 42 ringgit per dollar. So you are converting, you're exchanging, you are converting the balance sheet previously at 35, now at 42. What will happen? Your assets value will decrease, but at the same time, your liability value will also decrease. So overall, your net asset will decrease. So how to cover this risk? How to hedge this risk? There can be possible two solutions. Number one solution is take the maximum amount of loan in that currency. Why? Because if you convert the assets of subsidiary, you will face the loss. But if you convert the liabilities of the subsidiary, you will get the gain. So number one solution is take the maximum amount of loan in the subsidiary currency. Second thing, if possible, convert the assets of the subsidiary into parent company currency. For example, if your subsidiary in Pakistan, parent company is in America. So if you convert the additional or surplus asset into dollars, you do not need to convert dollar into dollar. So there can be two solutions which is written here. Arrange maximum borrowing in the subsidiary currency, because in a depreciating currency environment, if you convert the subsidiary assets into parent assets, you will face the loss. But when you convert the subsidiary liability into parent liability in a depreciating currency environment, you will get a gain. So your loss will be partially offset by this. So these are the two solutions. Next one is economic risk. Economic risk is, for example, let me take the scenario from the past paper. For example, this is a Europe. This is USA. This is like Italy. This is France. So both of these companies are competitors. If euro start depreciating, if French currency start depreciating compared to the dollar is appreciating, euro is depreciating. And both are doing business here. So for the people of Italy, euro will be more convenient, because if they buy in euros, it will become cheaper. But if they buy in dollar, it will become expensive. So the sales of France will increase, sales of US will decrease. So what is the solution? This is economic risk. If this happened for few days, that is okay. But if it happens for a longer period of time, that is called the economic risk. So economic risk, if it happens only for one transaction, that is transaction risk. But if it happens for a longer period of time, that is called the economic risk. So what is the solution of the economic risk? This company should open the subsidiary in France or Italy, so that it can make products locally and didn't get any disadvantage from these companies. Like the Apple did, Apple opened its subsidiary in China and it started manufacturing products at a cheaper rate. So what will happen? What has happened actually? Apple reduces its manufacturing cost. And plus, Apple is now present, and Apple is now made in Asia, so it is more approachable to the Asian market. It is manufactured in China, so it is directly in a competition to the Chinese companies. Number two, this is number one. Open your subsidiary there. Second, make such an innovative product that other competitors cannot compete you. Diversify into different products that other competitors cannot compete you. Diversify into different markets where competitor is not present. That's the solution you can look for. These are the solution for economic risk. So every company can face the economic risk if its comparator currency starts depreciating. And if you're importer and your home currency starts, if you are importer and if your home currency starts depreciating, you will face the economic risk because the local manufacturer will get the benefit. And if you are the local manufacturer and your home currency starts appreciating, your country importer will get the benefit. Like in Pakistan, if rupee start appreciating, what will happen? The local manufacturer of Pakistan will suffer and the importer will import all the things from the other countries and start selling at the lower price. So this is called the economic risk. Economic risk is, by the way, longer form. If there is a permanent shift in the exchange rates, then there will be a economic risk. You need to remember, you need to know what is economic risk and what is translation risk. Okay, transaction risk, these are the hedging methods. Netting is important. Netting advantage and disadvantage are very, very important. You should know. Number of currency transaction can be minimized. Saving transaction cost. Focusing the transaction risk onto smaller set of transactions that can be more cost effective. Another advantage of netting is it may also be the case if exchange controls are in place, limiting currency flows across the border. The balance can be offset, minimize overall exposure. For example, if there is exchange controls are in place, using the netting, you can control the flows. For example, I want to pay to the American company wants to pay some other company in Pakistan. So we can both offset with each other. Where group transactions occur with other companies, the benefit of netting is that exposure is limited to the net amount, reducing hedging costs and counterparty risk. Disadvantage, some jurisdictions do not allow netting arrangement. There may be taxation and other cross-border issues. There will be costs in establishing the netting agreements, and where third parties are involved, this may lead to reinvoicing, some cases recontracting. In netting, we normally net the amounts with each other. So maybe the auditors or the regulators require that now the amount has been changed, so you have to reinvoice or recontract it. So you need to remember the advantage and disadvantage of netting. By the way, it can be tested straightforwardly in an exam. Okay. Advantage of forward and future and option can be tested. What is the advantage of forward? It eliminates the currency risk, as foreign currency exchange costs are determined upfront. They are tailor-made and can be matched against the time period of exposure. Therefore, they are referred to as complete hedge. In forward, there is no need to deposit the margin. There is no basis risk. They are very easy to understand, easy to handle compared to future contract. But the major disadvantage is it is subject to default risk. There may be difficult to find the counterparty. They are legally binding, so difficult to cancel. It is difficult for anyone to get rid of this contract earlier than the maturity. So whenever there's a forward contract and future contract, always remember that difference between OTC and exchange traded derivatives. The major benefit of forward is it is customized contract. There is no basis risk. There is no margin requirement. Easy to handle. There is no rounding off of the contracts. But the major disadvantage of forward is it is not It involves the counterparty risk, subject to default risk. There may be difficult to find the counterparty. If you enter into a contract, it is difficult for you to exit from it before the maturity. That is a problem of the forward contract. Then these are the money market hedge. So remember the comparison between over the counter and exchange traded. It is very important. So it can be tested straightforwardly in exam. The comparison between over the counter. What is over the counter? In over the counter, contracts are customized. In exchange traded, standardized contract. In over the counter, you can book any amount, any currency. Settlement date can be any. In exchange traded, currencies will be major. Standardized amount, settlement dates are major. In exchange traded, there is an initial margin requirement. Gain and loss will be settled on a daily basis. But in over the counter contracts, gain and loss will be settled at maturity. High risk of default. In over the counter derivatives, you have to do the contract with the counterparty. In exchange traded derivatives, you have to do the contract with the clearing house. So I have seen many questions where examiner has asked the comparison between OTC and exchange traded derivative. You should know the difference between these two. Okay. Over the counter option and exchange traded option. These are the future contracts. You should know the comparison between future and forward. Advantage. Commission charges of future trading are relatively small. Future contracts are highly leveraged financial instrument. You only have to pay lower amount and you can enter into a large transactions. Future contracts are leverage instruments. Leverage means you will pay very small amount in a margin. For example, you will deposit $2,000 in a margin account, but you can do a contract of like $200,000. It is possible to open short as well as long position. Long position means if you want to buy something. Short position is if you want to sell something. Disadvantage. The major disadvantage of future is leverage can make trading in future contract highly risky. Obviously, if you are doing a leverage transaction, it is risky. But what is the meaning of risky? You have deposited only $2,000 and you are doing the trading of $200,000. If there is any movement in $200,000, your $2,000 can be wiped out. It can easily be wiped out. So in simple words, future contracts are using the leverage and that is mean future contract is risky. Future contract is standardized product and written for fixed amount in terms. Lower commission cost can encourage a trader to take additional trades and lead to over trading. And the major disadvantage is it is subject to basis risk. So you need to remember, do the comparison forward, future, pros, cons. The major benefit of future is no default risk. Other major benefit is highly liquid. Available in major currencies. No counterparty risk. What are the cons? You have to deposit the margin. You have to deposit initial margin. Second, daily gain loss calculation. So contract is not easy. It's a difficult contract. And the other problem is have basis risk. Okay. Try to enter more pros and cons, guys. Okay, this is highly testable. The pros of future will become the cons of forward, and the cons of future will become the pros of forward contract. Obviously, you need to change the wording, but overall, the concept is same. Okay, the next is, you should know the initial margin. What is initial margin? What is mark to market? Maintenance margin or the variation margin? You should know the calculation. Then an option, you should know the comparison between you should know the comparison between the option with the forward and the future. By the way, easy. Then they say interest status management. In interest status management, you should know the comparison. You should know what is forwarded agreement, and you should know the future, advantage and future and disadvantage of future, options, collar. This is collar, by the way. Advantage of collar and disadvantage of collar, interest rate swaps, and the most famous and the most favorable topic of examiner is advantages of swap and disadvantages of swap. This is the most favorable topic of our examiner. He always asks the advantages and disadvantages of swaps. This is the most favorable topic. So you should know this theory. You should learn it at least. So do remember, let me read it. Swaps are, and let me discuss the advantages. Swaps are flexible instruments for managing interest rates for longer term funding. Remember, you learn forward, you learn future, you learn options, you learn collar. All are for short term. Forward, short term contracts. Future, short term contracts. Options, short term contracts. But swaps are the only instrument. Swap is the only instrument that is for longer period of hedging. Swap is a longer period of hedging. If you want to hedge the long-term exposure, use the swap contract. Remember it. Okay. Second, as a hedging instrument, swap give management the opportunity to manage the fixed floating rate balance of debt and investment. If you are hedging through the swaps, you can change the floating debt into fixed debt into floating. Take action in anticipation of future interest rate changes. If you are anticipating that in future interest rates are going to increase, you can change your loan into fixed. And if you are anticipating that interest rates are going to down, you can change the nature of the loan using swaps. Fixing the cost of debt for an extended period can improve the credit perception of the company. For example, if you are thinking that interest rates can go up, use the swap, convert the floating loan into fixed loan. You can change the perception of the company. There is an active swap market and position can be changed over time as required. You can change the position in the market. Okay, that's the beauty of the swap. Fourth point is, for example, interest rates are going up. So that means KD will also increase. But if you convert the floating loan into fixed loan, that means you have fixed the interest rate. That means you have decreased the KD. So financial risk will be lower. You can improve the perception or image of the company. Disadvantage, swaps represent a long-term commitment at a time when interest rates appear uncertain. It may be that interest rate rises are lower than expected. So swap is a longer term contract. Maybe after 1 year or 2 years, situation change. What you have to do? You have to reswap it then. Okay. Company will be liable for an arrangement fee. However, other methods of hedging which could be used will have a cost built into them. In swap, you have to pay the arrangement fee. You have to pay the arrangement fee. So that may be the disadvantage. So you need to remember the advantage and disadvantage. Then there is a swaption, currency swap. This currency swap is also very important. It has been tested in past papers many times. So what is the benefit of currency swap? Payment of interest in currency of the counterparty can be used to match the income will receive from the, okay. This is using the currency swap, you can reduce the foreign exchange risk. For example, if we are sitting in Pakistan and the other company is US, Pakistan want to invest in US, US want to invest in Pakistan. So using the currency swap, you can reduce the foreign currency risk. Reduce the foreign currency risk. For example, how? Pakistan want to have $1 million and US company want to have, for example, 250 million rupees. So they will exchange this principal now, and after a year or after 2 years, they will re-swap it against each other. So both have locked the currency rate for a longer period of time and avoid the foreign currency risk. It will be able to obtain the swap for the amount it requires and may be able to reverse the swap by exchanging with the other counterparty and is more certain than the other method of hedging this. You can get the desired amount if you are entering into a swap contract by negotiating with the other party. Cost of the swap may also be cheaper than the other methods. So cost of the swap is cheaper compared to directly borrowing into another country, into another currency. Swap can be used to change company debt profile. If it's weighted towards fixed rate debt, if the director want a greater proportion of floating, so you can change it to floating rate debt. Disadvantage of swap is there may be a counterparty risk. The other party can default. You want to pay, but the other party do not want to pay. Counterparty risk. Swap may not be worthwhile means of hedging currency risk if the exchange rate is unpredictable. If exchange rate is very volatile, then swap will not give you the benefit. If it is assumed that exchange rates are largely determined by the inflation rates, the predicted inflation rate is unstable, making it more difficult to predict future exchange rates confidently. So in swap, maybe one party become the loser. So if exchange rates are highly volatile, swap may not give you the fully expected benefit. A company swapping a fixed rate commitment in, for example, Eurozone for a floating rate in, for example, dollar. If the inflation is increasing in dollar country, there is a risk that interest rate will increase as a result, increasing Eurozone finance cost. So that is another problem. For example, in Euro, if you are exchanging the Eurozone interest rate with the dollar interest rates and interest rates of the Europe increase, so ultimately, you have to bear the risk. For example, let me explain. This is European company. This is US company. So this company borrows in euro. This company borrows in dollar and swap the principal. So ultimately, US company has expired in dollar, in euro, and euro company has expired in dollar. What if a future exchange rate results in increase in euro interest rates? So USA company, which changes its exposure into euro, has to pay the higher interest rate in the euro. That may be the case. So you should need to remember the advantage and disadvantage of currency swaps. Okay, then this is an example. Okay, this is very important. This is a technical article. There is a video available on the LMS. I have uploaded that video. Virus management. Do read it before going to exam. This is very, very important. Even like 2 to 3 points have been tested in December attempt as well. So these 2 pages are very important. These 2 pages. 1, 2, 3 pages. Virus management. These 3 pages are very important. You need to remember this. Risk diversification. Raising equity capital to pay off the floating rate debt. Okay, do read it. That's the total theory of risk chapter. If let me summarize it, examiner can ask you the comparison between forward and future. Examiner can ask the comparison between OTC and exchange traded. Derivative. Examiner can ask between the comparison between option and forward or future. Examiner can ask you the advantage and disadvantage of swaps or currency swap. This is also important. You should also read risk management article. By the way, it is available on LMS. The discussion video is available on the LMS. Plus, you should also read the central and decentralization of treasury function. So these are the theoretical points which are very, very important and has been tested in past papers many times. Okay. You should read about these. Except these, maybe examiner asks you to, okay, these are the maximum points which can be tested. So this is not relevant with the risk management. In value at risk can be tested at 3 probability level. Probability 1%, 5%, 10%. Confidence level will be 99%, 95%, and 90%. So you need to calculate the probability level. Okay. At 5%, let me explain it. At 5%, if probability is 5%, probability table value is 1.65. So how to calculate the value at risk? Probability level into standard deviation if standard deviation given in dollars. Otherwise, Probability level into standard deviation if it is in percentage into fund value or the loan value or the asset value. That's how you will calculate the value at risk. Now the question is how to calculate this 1.65. Your question. Okay. Number one, we will be provided with the probability, with the normal distribution table in exam. And that normal distribution table, what is normal distribution? Normal distribution means whenever there is a fluctuation in the asset price, this is the mean. Mean कहते हैं average को. Mean is the average of the data. There will be fluctuation equally above the mean and below the mean. Mean means average. There will be 50% movement above the mean. There will be 50% movement below the mean. And value at risk will always be in the tails. This is the value at risk. How much you will lose, that is value at risk. So you will be provided with the half table. So table total value is 0.5. Deduct your probability from the total value. For example, you are calculating for 1%. You are calculating for 1%. So deduct 1% from 0.5, that is 0.01. Now search 0.49 from the table. I will explain that how to search. Okay, at 5% probability, total table value is 0.5. Deduct the 5% from 0.5. That is 0.45. Now search 0.45 from the table. And at 10%, total value is 0.5. Deduct the 0.1 from the table, that is 40. Now search the 40 from the table. Now let me open the table. I'm hoping there will be table here. Yes. So for first of all, 0.49. Search the 0.49 from the table. So it is, if you are following the cursor, here it is, 0.49, mid of the table, 0.49. Now read across the line. Let me copy it. Let me copy it. .49. This is 0.49 approximate. So read it 2.3 and go to here. 2.3 and 0.03. It will be 2.33. So at 1% value is 2.33. Now search 0.45 for 5%. 0.45. 0.45 is like near to these. The average of these, I can say that. So this is 1.6. Now move above. If this is the average of these, it must be average of these two. 1.645. 1.645. Or you can say it is 1.65. Okay, now search 0.4 for 10%. 0.4. 0.4. This is the nearest to 0.4. 1.28. 1.28. So that's how you will calculate the table value for the value at risk. Okay. Here, got it. Now will you calculate it? Use of table, yes. So any other question, guys? We have to solve a 50 marks question. So I think in today's session, it will not be possible to solve that question. So that's why I'm taking your questions. If you want to discuss something, do let me know. In tomorrow class, we will discuss that big question. Any question, guys? Lock-in rate and closing future rate. Very easy. Let me explain it. Don't worry about that. Look, lock-in rate will be tested in currency future. Anyone remembers the formula, guys? Anyone remembers the formula? Lock-in rate. Opening future minus okay, this is the formula, right? Okay, use this formula. It's my request, it's my humble request. Use this formula, whatever the case in the exam. Use this formula. Formula is opening future. Opening future is that rate which you have selected in step number 2 or 3. Minus, it will remain minus, whatever the case. Whether the trend is increasing, whether the trend is decreasing, it will remain minus. Current spot, if you are using the exporter, current spot will be different. If it is a case of importer, current spot will be different. Into remaining months divided by total months. How to calculate the total months? Current spot, write the date of today. For example, today date is 1st January. For example, you have selected the June contract, 30th June. So total months are 6. Now estimate the remaining months. You have selected the June contract, but you are executing transaction at 1st May. So remaining months are 2. You are executing the transaction on 1st June. Remaining months are 1. You are executing the transaction on 1st April. No, that will not be tested. Either it will be 2 or 1. Okay. That's the lock-in rate. Okay. What about the closing future? Closing future will only be calculated in interest rate future. Only in interest rate future. Its formula will be closing spot plus, please confirm someone. Opening future minus current spot into remaining months divided by the total months. So this will be same in both cases. The only change is in lock-in rate, you will take the opening future. In closing future, you will take the closing spot. That's the only difference. That's the only difference. Okay.
सर करेंसी फ्यूचर्स में हम क्लोजिंग फ्यूचर भी नहीं कैलकुलेट करेंगे?
नहीं करते ही नहीं है। बहुत कोई पुराना क्वेश्चन, एक क्वेश्चन है केवाईटी के नेम से, अगर आपको याद हो, उसी में आया बस। एग्जामिनर नेवर टेस्टेड in last 10 to 20 years closing future in currency future. You can solve the question using lock-in rate. That's it. ठीक है, okay.
ओके सर, थैंक यू।
Okay, one of the student has asked about the mark to market calculation. Let me explain it. Let's suppose you have entered into a future contract. For example, buy future at 1.2040 dollar over pound. Buy future. So that's the opening future. And you have done this on 1st January. Mark to market will be tested in part B. Remember this. Examiner will never test mark to market in A part. So in 1st January, you have entered into a contract that you will buy dollar at 1.2040. Okay. In 2nd January, and for example, you have number of contracts are, for example, number of contracts are 50 and contract size is 62,500 pound. I'm just assuming this is the number. So in 2nd January, future moves to 1.2060. You have entered into a contract that you will buy at 1.2040. Market moves to 2060. So it's a gain. So you will calculate the gain, and 2nd January gain will be the difference between these two, 0.0020. This is a gain on one contract into 50 contract into 62,500 pound gain. Then compare your answer of 2nd January with the 3rd January. In 3rd January, let's suppose market moves to 2052. You will buy at 2060, market moves downward. Now what will happen? You have a loss. Take the difference of these two, 0.0008 dollar over pound into 50 contracts into 62,500 pound. That will be your loss. So, and let's suppose there is a 4th January as well. In 4th January, market moves to 2070. You will buy at 2052. Now market moves to 2070. Again. 0.0018 into 50 into 62,500. So what is the learning here? Whenever in exam there is a mark to market calculation, 1st January will be compared against the 2nd January. 2nd January will be compared against the 3rd January. 3rd January will be compared against the 4th January. So you will compare today with tomorrow. Then you will compare tomorrow with the day after tomorrow. Then you will compare the day after tomorrow with the day after 2 days after the tomorrow. Okay, that's how mark to market will work. Right? Got it? Okay. Any question? Because I have to assign something for you, something to you for tomorrow class. Before tomorrow class, please revise over the counter option. Video is on LMS. And if you cannot find, video is also on my YouTube channel. Second thing, please revise types of foreign currency risk. Please revise, please solve Lignum company question from past papers. Guys, please take the screenshot of this. Please take the screenshot of this. Okay, this is for tomorrow. Okay, there is a question. Sir, in option contract, why do we divide the transaction amount by the excise rate when we are calculating the number of contracts? Look, you're talking about the currency, right? So the formula of number of contract is foreign currency amount over the contract size. If foreign currency is in dollars, contract size is also in dollars, both will be cancelled out each other, and you can calculate the number of contracts. But if foreign currency is in dollars, but the contract size is in pound or the euro, both cannot be cancelled out with each other. So what to do? What to do? We have to convert the foreign currency rate at the expected future rate at which you are going to close the transaction, not the today's spot rate. In some of the books, writer use a today's spot rate, but you should use that rate which is going to happen in future. Obviously, you don't know that rate, but you know the excise rate. So divide the foreign currency amount using the excise rate or the strike rate so that you can able to convert the foreign currency rate at that rate which is going to happen in future. Okay, that's why we use the excise rate for the conversion of foreign currency to the same currency of contract size. Any other question? Guys, please take the screenshot of this because you need to revise this before tomorrow class. This is very important. Any question? Okay, no question, guys. Okay, if there is no question, I'm winding up the session. We will discuss in tomorrow class the latest attempt question, but it's my humble request, do revise all these three things before coming to the tomorrow class. Done? Okay. Okay, guys. See you tomorrow. Take care, everyone. Thank you so much for joining in. Gigi, you want to ask something, Shazan? Shazan, sorry. अच्छा वो कहाँ पूछ रहा है भाई? Where are you asking the question?
सर समीला ने 3 दफा पूछा है।
कहाँ पूछा है? भाई ये स्पीकर पे, माइक पे, सॉरी. बट समीउल्ला, आई एम नॉट लिस्टिंग. मुझे आवाज नहीं आ रही. Okay. If there was no over and under hedging, what will be the next step after calculating the loss? So it's a very easy. Look, I think fifth step is lock-in rate. For example, lock-in rate is 1.082, for example, dollar over euro. Last step will be either the expected receipt or the expected payment. Take the foreign currency, convert into home currency using 1.082 dollar over euro. Bas, that's it. ये करना है आपने. Calculate the lock-in rate and then calculate the expected receipt or payment using the lock-in rate. Okay. By the way, Samiola, तुम कहाँ पे पूछ रहे थे question? Where are you asking the question? You were asking on the mic. One more question, sir. Sometimes the future and spot rates are different. For example, future rate is it's excellent question. Sometimes future terminology and spot terminology is different. What we have to do? We have to convert the spot rate into the same terminology of the future rate. If I correctly remember, it has been tested in past paper in 2 questions. KYT, it's a very old question. So you can leave that. Recent time, it was tested in Lirio question. Question name was Lirio. If I'm not wrong, that was the name of the question, Lirio. Okay. So for example, future terminology is dollar over euro, but the spot is euro over dollar. So convert the spot into dollar over euro by taking the inverse. For example, if it is written 0.88, you can convert it into dollar over euro by taking the inverse. 1 divided by 0.88. Okay. Right. Any other question? Thank you so much. Take care, guys. Thank you for joining in. एंड समीउल्ला, आई एम वेरी सॉरी यार, मुझे बिल्कुल आवाज नहीं आई थी। मेरा कोई कसूर नहीं है। टेक केयर गाइस। थैंक यू सो मच फॉर ज्वाइनिंग इन। It may be some kind of glitch, but I didn't hear anything. बाद में एक स्टूडेंट ने बोला था, the other student was saying something and I listened that. Asking the chat box, but in my chat box it was not a bearing. Okay. But I think there was some problem in the setting. Samullah messages are at the top. Today we have a lot of questions. Okay, I have listened that. It if there was a no over and under, I think what will the next step? Okay. My question, sir. I asked one question 3 times, but no answer. I think sir is not seeing my question. Yes, Lirio, please repeat. Okay. Yes, there is some kind of glitch because when I was scrolling uh, these, so I don't know where these messages are appearing, but now I have seen that Samula messages are appearing at the top of the chat box, which I have to scroll up to see it. वो मुझे ऊपर जाके देखना पड़ रहा है. चलें समयोला साहब, कल सही. Take care, guys. Thank you so much. Allah Hafiz.